Hello, guys. I hope you're having a wonderful time wherever you are around the globe. My name is Delight Mekwa, and I will be your course educator. Now, without any waste of time, let's dive deep into it. Please take as much time as you'd like to read the disclaimer here. You may pause the video if you feel like it. Unit 1. In Unit 1, we are having Part A and some other parts that follows after Part A. So, we are going to be learning about the financial cycle. In these terms, we are going to be focusing mainly on Forex. And then we're going to look deep into the market's direction and the nomenclature, which is the terminologies that are going to be used throughout this course. Types of market trends, change of character, the direction of a trend, or rather the trend switch. Support, which is also known as the floor, resistance, considered as the roof, plus breakout and retest. We're going to look also at diagonal support and resistance, breakout and retest entries. I hope you're ready. Let's now prepare ourselves for the most wonderful moment. Now, before we dive deeper, here's something I would like to let you know about this course. We have been conducting researches, not just one, but we have made many researches concerning the financial markets over a period of close to a decade. And when I say we, I mean because as Onyx is a body with many parts that are functioning to help each other. Of course, for a better performance. I hope you guessed it well. So now, I need you to pay attention. The information that we are going to be providing here is an information that we have used ourselves. We are still using till this day to find better opportunities in the market. But there's no any chance we are going to guarantee to you that the information that you're going to learn in this course guarantees your success. It all lies down to how well are you using this information and how much more of personal researches you are conducting on your own. Remember, you can never become a successful Forex trader just by learning a certain strategy. There's a whole lot of information needed. You need to learn the psychology of the market. You need to learn also the money management risks. So here right now, we are on the introduction. Financial markets trading. Let us look at this part here. We have here what we call the central banks. Some people may refer to them as the big banks, the banks that are controlling the world, as many people likes to say it. That's where the money is, So the explanation that I'm going to use here, it may not be exactly the explanation you will find on the internet, or rather when you look deep into the financial institutions. But rather, I will try to explain it to the simplest form so that you understand what I am trying to help you understand. Get it right? I hope you do. Now, check this out. We have what we call the central banks. The central banks are where the money is. I'm going to tell you a short story. Be it true or just a fiction. Listen to understand. Let's say back in the days, it happened that there was war. And that war affected so many countries and left them broke. Literally broke to a point that they ended up having to find some people in the world who were moneyed. Or rather some organizations, of course. It may not specifically be people as individuals, but maybe as a collective. So they found those people and they went to those people to lend some money. You can imagine those people, of course, the first question they're going to ask is, what's in it for me? So these countries, they go and they find those people, and then they lend money from those people. Now, as they lend money from those people, they're expecting their profits, right? Sure. Now, this is where I can say it all starts. What I mean by that is people borrowed money from other institutions, and then those institutions, or rather those collective individuals, they began to operate as banks. Now, let's talk about international banks. When a certain company uh, starts to operate as an international bank, obviously the country at which that bank is gonna be used for transactional purposes when it comes to instruments, when it comes to money, monetary transactions, and perhaps some other forms of transactions that may be, offered according to their services. So the international banks, as they are used by their countries, they go into the central banks, of which you and I know where they are. And when they got there, what they did is to borrow money. After borrowing that money, now the central banks, they tell them, we are going to give you this amount of money, but what we actually need you to do is to return it with some profits. Okay, they agree. And then what they do, those big uh, international banks, as sent by their countries, of course, they end up realizing that, oh, okay, it means that we are going to need a strategy to find a way to raise money so that we can end up managing to pay back our debts to the central banks, right? And then we have small banks, which are also regarded as local banks. I mean, each and every country has a bank that is operational within that country, but you find that it's not international. And then those small banks, what they do is that they go into the big international banks of those countries. They borrow, or rather they take some loans, and then they loan their people. They loan small or rather big companies. Think about the Silicon Valley, for example. You think Silicon Valley just started just like that? Obviously not. They had to somehow, those big gigantic companies, they had to somehow go deep and seek for funding from some potential investors. Now, I want you to think about it. In those countries, or rather in that country which the Silicon Valley is, there are so many small banks that would obviously love to work with the big companies, okay? And then those small banks, they start borrowing or lending money to the big companies in that country. And then, of course, comes people like you and I, who wants to, operate online businesses. You want to sell a product, or think about Amazon, for example. They go back now again into those big companies. They again take some loans to start their own businesses. And then, the cycle continues up until they reach to the small companies which are owned by individuals, companies which are not owned by many, many people, And then what happens is the cycle just keep on going and going. There's an exchange of money via the payment of the profits to the people that, or rather the companies that the other smaller companies, they took money or loans from. I hope you get all these cycle. Like I said, this may not resemble exactly what is happening in the forex market, but I do believe that it opens your eye to understanding how the financial market works. So, all of this cycle, every transaction that is happening in here, we live in a digital world, remember? That transaction is recorded. Now, those recorded transactions, they are kept somewhere in the cloud, analyzed by big algorithmic machines, the MLL, you name them. And there's a specific amount that the money revolves around, and that amount is plus $6.6 trillion a day. That is the reason why the forex market is one of the most lucrative, volatile market in the world. It's easy to make money. It's easy to also lose money in the forex market. Now, you and I want to participate in this big cycle. We want to make anticipations. We want to forecast. We want to predict. We want to, as we deal with probabilities, right? Because each and everything that is happening within this cycle of the financial markets, there's absolutely, absolutely a way to participate. But there are some regulations, there are some certifications. You need to, for example, find a broker because they have the necessary papers that allows them to participate, or rather give access to you and I as the retail traders. So, in order for you and I as a retail trader to be able to participate in this forex cycle, this big financial gigantic cycle of money revolving each and every day, we need a broker, which is also considered a middleman. Now, here's what happens. When you create an account with a broker, your broker as well, just as any other company, is looking for a way of making an income. So they are going to charge you for their services. And what they are going to charge you is called the swap, or rather the commission. In other words, the broker has a certain percentage that is going to take from all the transactions you are going to be making as through him as the middleman. So now, I need you to understand that before you can have a brokerage account, you need to first have a personal bank account, which, of course, in this case, may be whatever bank you choose for yourself in your country locally. Or rather, if you are having an international account, then you can also use that international banking account, of course. And that is how you're going to be able to take your money from your personal account, deposit it into a broker, and from there, you are going to be able to make transactions and participate in the big forex market. Now, listen to this. When you are participating in the forex market, what you are going to be doing is to make predictions. For example, let's say maybe you are making a prediction about the stock of this online business. Take an instance, Amazon. Let's say maybe you want to predict. And if your prediction is correct, of course, depending on your money management, that's where you're going to make your profit. But if your prediction about the growth or the fallout of the company was wrong, and you have participated in that price action movement, then that is where now you lose money. Okay? I hope this makes sense. I know this may not be the most perfect explanation ever, but I do believe that it's helping you to really understand what is happening in this financial markets trading. Okay? Now, we look deep into what we call the market chart types. Market chart types. If you may remember in mathematics, it doesn't matter, of course, if it's mathematical literacy or whether it's math literacy or whether it's pure mathematics. Some people, they just refer to it as mathematics. We always have graphs to make representations of whatsoever kind of statistics that we have gathered or that we are studying. So in the market, likewise, we do have charts. We do have different types of charts. And you and I are going to be focusing mainly on the candlesticks chart. But I want you to be aware that there are other different types that are mainly used by many other traders out there, which is the line chart, the bar chart, and of course, many more others, which we are not going to be discussing in this course, of course, because, like I said, we are going to be focusing on the candlestick charts. And also, throughout this course, we will be using the line chart to make better explanations, as it's something that I found it very easy throughout the compilation, or rather throughout the construction of this course, to make line charts somewhere, of course, because it was time saving, and they are very easy to understand as well. So I hope you really do understand what all this means. Now we dive into the following topic: market's direction. Just like a number line, we have a number line here, and we are having 0, -1, -2, 1, and 2. Okay? So in a number line, I need you to notice that when you are standing here, let's say you're standing here at point 0, in order for you to go to the positive side, you will have to move to the right-hand side direction. And that is exactly what is happening in the market. Remember, moving backwards into the negative, it's more like traveling back into the past, right? And of course, you and I don't have those abilities unless we look deep into our memories through reminiscing or whatsoever kind of way. But I need you to understand this basic concept that I'm trying to explain here, that from here 0 is it's our current focused moment, and then we are going to be moving from 0 into the future, which is 0, 1, 2, 3, etc., etc. Now, the market moves from left to right all the time. The market's direction is always from left to right, though it may slightly be up and down. Okay? So, what I mean by that is, let's take for an example our water tap here. We connect the pipe here, and then we switch on the tap so that we can start having some water flowing through the pipe, right? Now, I need you to focus on the pipe. The pipe's direction from the tap is moving from the left-hand side to the right-hand side. But in the middle of this pipe, as you can see, there's this mishmash kind of jiggling, right? Yes, check this out. The water was flowing within the pipe, going down, going up, down, up, down, up, down. But of course, you and I have noticed the overall direction, including those ups and downs, was to the right hand side. So that is exactly how the market moves. The market moves always from left to right, meaning the market always moves from the past to the future. Because of course, each and every person that participates in a business, they are hoping to see growth more and more tomorrow. There's nobody who makes an investment hoping to go back into the past just to have their investment making some profits. I mean, like, the past is the past. That's where it belongs. So, like we said about our nomenclature, we have a term called buy. In some other brokers or other platforms, you will see a term called call. Now, the buy term here means a bet made in prediction that the market will go up. For that, we can say the market will rally or the market will rise. We also have here a term named sell, which is a bet made out of speculation that the market will go down, which means the market will drop or rather fall. And then we have another term here, which is named entry point. This is very fascinating because our entry point is exactly what determines whether where we entered, where we started to take participation in the market is allowing us to be in the money or out of the money. Entry point is a price level at which the trader place or rather take their trades. I hope you get that. Of course, each and every term that is being explained here, as it's gonna be used more and more, you are gonna understand it as the course continues. So we have another term called stop loss, also abbreviated SL, is an amount that the trader is willing to risk or to lose on their trade to protect their account from losing all their account in case the trade goes bad. Meaning, in trade, their speculation did not go into the money. And then, of course, we have here a term called take profit, TP. The amount or profit that the trader will get if if their trade goes to the level at which their predicted amount is going to be. All right, let me say it reading what is written here. The amount or profit that the trader will get if the trade goes to the level at which they are predicted, at which they predicted that the market will reach before hitting their stop loss. Now, what does that mean? It simply means that from your entry point, you're going to be having a stop loss, which is the amount you're willing to risk in order for you to discover whether your prediction or rather your forecast is going to go into the money or will get out of the money, which means you lose. Now, from that entry point, opposite of the stop loss, you will have your take profit. So should the market reach your take profit price, your take profit level, it means that is the money you are going home with, baby. Isn't that fascinating? And here, the purpose of this course is to equip you with information that will help you to make better decisions when you, of course, make those entries, set up your take profits, set up your stop losses. But then remember, just like it has been said in the disclaimer, we are not going to be held liable for any losses. You are fully responsible, so please always make sure you verify your information very well, and if need be, seek a professional advice before you make any investment. Deep into the next topic. Introduction to market trends. Now, like we have been talking in the previous lessons, that the market has a direction, right? And just like in our tab, in our tab water pipe illustration, there's a point where I mentioned that the market is moving from left to right, though it may slightly be moving up and down. Now, in the market, we have what we call an uptrend, which is also called the bullish trend. And then in this up bullish trend, what we focus on is to buy. Okay, I'm going to explain shortly what I mean by that. Let's look deep into what actually makes a trend, or rather what actually helps us to notice or rather recognize what kind of a trend we are in the market. I need you to look at this. We have here our y-axis and we have here our x-axis. Now on the y-axis, we have our price. It may be in dollars, rands. It depends on the currency. It also depends on the instrument you are trading. And then here on the x-axis, we have the period, which is the independent variable. 1, 2, 3, 4. It may change according to the time frame which you will select in the platforms that you will be using. It may be, you know, something else, but it's still time. Okay, when I say something else, I just simply mean it may be different time intervals of maybe 12, 24, blah blah blah, as it goes. Now here we have what we call an uptrend. I'm gonna explain to you how we are gonna be able to spot out an uptrend. If the market is in an uptrend, you are going to see it by having a series of higher highs and higher lows. Okay, I know, right? I need to make that clear. Let's say the market is here, and then there are buyers participating in the market. The price rallies, it goes up, and then it turns, goes back down. Now, the turn at which it made, it was at an upper level, which is a high point, which is this one. And then it went down to form a lower point. This H here stands for high. This L is for low. And then the market goes up again, breaks that high point, forms another point which is high. And this point, if you look, it's higher than this previous high. So we call this one a higher high. And then it comes down to form a low. It turns, this point is lower than this high, but this low here is very high than this low. So we call it a high low. So the market goes up again, breaks this horizontal level of the previous higher high, forms another higher high, which is higher than the previous higher high. And so it continues. So that is what I meant when I said, if the market is in an uptrend, you will see it by having a series of higher highs and higher lows. Now, in the market, just like in mathematics, um, there's something we call I think is reciprocation, and that goes like what you do on the left hand side, you also do on the right hand side, or rather, the principles you apply on the left hand side of the equal sign, you also apply on the right hand side of the equal sign. So in the market, normally what we have is the counterpart. If we have here an uptrend, we are not going to be having a left trend, for instance, and maybe a right trend. No, in the market, we have an opposite of that. But it's not about like hand sides, it's about up and down. Yes. So just like we had the uptrend, we have also the downtrend. Now, an uptrend, as I explained, it's formed by a series of higher highs and lower lows. And then a downtrend, we are going to see it by a series of lower lows and lower highs. Let me explain what I mean by that. Let's say the market was rising. As it was rising, it got to a point where it turned, right? We know, you and I know, there's no market that goes up forever. There's no market that goes up forever. Okay. So now, as we know that the market goes up in as much as it also goes down. Of course, the length may be different, and that does not actually mean that the market will go up at the same range that it also goes down. But it just simply means that the market goes up, and we know there's a point where maybe the company is not performing well. They might have changed their CEO. They might have fired or hired some people that are somehow making some big contributions that may cause the family, the company, of course, to I'm thinking about it because the company is a family, and so is the market. The market has a collective of what we call a family in the nomenclature. So here is a downtrend. The market goes down, forms a lower point, it turns, goes up, forms a higher point, but it comes back down. But this time around, it goes even lower than the previous low. And then we call this point a lower low. It goes back up, but this high that it forms when it turns here, it's not higher than that previous high. It's actually lower than the previous high. So we call it a lower high. And then it goes down again, forms a lower low, goes up, lower high, lower low, lower high, lower low, lower high. So now, just by looking at the market, checking whether the market has been moving consecutively, forming a series of higher highs or higher lows, higher highs, higher lows, or rather lower lows or lower highs. You can simply tell whether the market is in an uptrend or a downtrend. Okay, those are the two main trends in the market. But we have here again what we call consolidation, known also as ranging or fluctuation. In a consolidating market, there's no clarity of the actual direction where that the market is trading. We know the market is moving from left to right, but like we said, slightly to the up, slightly to the downside. But here now we see the market has formed a high, it forms a low. It forms a high, it forms a lower low, it forms a higher high. Now it forms a low. It forms a lower high, you know. So there's no clarity here. In other words, there's no consecutive higher lows, higher highs, lower lows, lower highs that we can see following each other consecutively. So what does that mean? It means that we are not sure of the overall directional trend that is happening here, and that is coined consolidation. So consolidation simply means a ranging market. It simply means a fluctuating market. It's not an uptrend, it's not a downtrend. It's simply just consolidating. I hope that makes enough sense. Of course, there will be a panel where you will be allowed to ask any kind of question that you may be having regarding all the lessons that are going to be given to you throughout this course. Let's continue. Now, we have been talking about an uptrend. We've spoken about a downtrend. Now we want to know. Okay, maybe you ask. I'm noticing here that we are having a high, a low, a higher low, a higher high, a higher low, higher high, so on and so on. But when exactly will we know that the market trend is changing? Just like the title says, change in trend direction. That is exactly what I'm going to be explaining here, because that is how we are able to position ourselves into making better decisions to ride the trend. And my apologies. Let me go back again here. There's a slogan, or rather an axiom. I don't know what you call it. It says, trend is your friend. If you find any trader not understanding this, especially a trend following trader, not understanding that trend is your friend, there's a lot to question. There's really a lot to question. What this actually means is that never trade against a trend. For example, let's say we are here on a downtrend. Never sell on a downtrend. Never buy on a downtrend. Okay, I realize I almost missed a very important point here, and that's why I also came back. In the bullish trend, which is an uptrend, What we focus on is that we want to ride the trend. Now, let's say the market forms a high, a low, a higher high, a lower low, and a higher high. Now, we have already spotted that this is an uptrend, right? What we want to do is to target a point where the market is giving us a higher low. And that, on that point, is where we are going to be targeting to buy, or rather to call. And if we buy, let's say here, the market goes up. As it goes up, your entry level will be here. It means that you will actually be in profit. But I'll explain that later on as the lesson goes. I just wanted to bring that into your attention. Yes. And here in a downtrend, we have a low, a high, a lower low, a lower high, a lower low. When the market gives us a lower high here, we start to realize, oh, we've been having a high and a lower high. We've been having a low and a lower low. Okay, this signals to us that now the market is in a downtrend. And in a downtrend, since our friend here says trend is our friend, then it means we do not have to violate the trend. We have to go in the direction of the trend. By that, I mean in the downtrend, we are mainly going to focus on only on sell. So here at this level, we are going to target and look for whatever reason that will give us a chance to sell. Then we sell. As the market drops, we make money. But should you, for example, buy here, the market drops and you are out of the money, you are not in the money, and let's say maybe you are convincing yourself that maybe this is the last 10 of a downtrend and you want to catch the uptrend as soon as possible, right? When you buy here, the market may go favorably into your direction only for a little while, just to come back and take your stop losses and hit your stop losses, meaning take you out of the money. I hope that is clear. Now let's continue. Changing trend direction. Changing trend direction is the most vital thing that you and I need to understand. So many traders that I've met throughout the years, they would say things like, I can have a wonderful entry in the market goes into my direction, but then later on it comes back just to hit my stop loss, whereas I was in the money, and then the market comes back and I end up losing the money. And then that explains to me exactly what they lack. It means they lack the understanding or the information, or rather the knowledge, that when the market is changing, it signals to you that I'm about to change. Let me thoroughly explain that. The market is like a language. Think about the musical language. You see some notes which a keyboardist, a guitarist may play. Is there such a word as a guitarist? I hope I said it correctly. And then they play a melody just by reading the note. All right. Let's say, for example, you don't understand how to read Chinese, and then somebody sends you a letter written in Chinese warning you that your enemy is at hand about to devour you. Will you be able to run away, or will you be able to take caution according to the warning? Absolutely not. Why is that? Simply because you don't understand the language. You're going to need a translator, right? Sure. So the market, the charts, the graphs that we are going to be interpreting, they are just like that. They are a language of the financial markets. In other words, when the market is trending up, that is a language. When the market is trending down, that is a language. When the market is switching trends, changing trends, that is also a language that you need to translate in order for you to understand. Okay, I hope you get that. We have a high point, we have a low. The market breaks this high point, and that we call a break of structure, because as you can see, the market went up, came back down. We have a structure here which is a high point, and then the market goes up to break that higher point, that high point. We call that the BOS. BOS simply means break of structure, as clarified here. Now, the market comes back down after forming the higher high, comes back down, forms a higher low, meaning this low is higher than this one. Already, just by analyzing this, we can tell that, just by analyzing this, we can tell that the market is in an uptrend. The market is uptrending. Why? Because it has given us a series of a high followed by a higher high, a low followed by a higher low. What you and I begin to look for is whatever confirmation, of which you are going to learn, of course, throughout this course. We're going to look for a confirmation that will signal to us to take our buy entry somewhere around here. And then after getting that confirmation, we buy. As the market rises, we are in the money. Our stop loss is going to be focused, or rather set on the lower point, the latest lower point, which is this high low here. And then the market goes up. As it goes down, up, down, up, down, up, the overall trend is uptrending. When the market is here, you notice that, okay, from this point up until this point, there is a difference in the range at which the market has moved, which means you are in the money, you are in profit, okay? But where exactly will you take your profit? And this is the most fundamental thing that you need to really understand. The market goes up and then the market comes down. But this time around, the market actually breaks the previous higher low. It closes below the higher low and it forms a lower point, meaning this point is lower than the previous lower point. So it makes it a lower low. What does that mean? It means change of character, which is the church. So the minute you spot this out, you have to be aware that the market is telling you something. It's telling you something. It's really telling you something. Remember, the market goes up, goes up, goes up, forming a series of higher lows, higher lows, higher lows, higher highs, higher highs, higher highs, higher lows. And if you can check, when the market goes down, it was not coming below the previous lower point. It was continuing going up without breaking the structure of the previous lower point. But here, exactly here at this higher low, the market comes back down. Instead of turning somewhere around here, it comes back down to actually break this higher low, the previous low, and then it closes below. That right there we call the change of character. And that is exactly what signals to you that the market is initiating a new trend. And that's where now you take your profit, because you understand, oh, okay, if the market is switching up, then I don't need to allow my money to go back again and drop. You will get to understand that more and more as the course goes, of course. What I'm trying to explain to you is that each and everything that you are learning throughout this course is a link. It's actually intertwined. The first thing is linked to the second thing linked to the third thing linked to the fourth thing, but it actually does not mean that you have to forget the first thing. You're still gonna need it. So please, Make sure you focus. And then, just after breaking this higher low, the market gives us what you call a change of character. Gives us a lower low, goes back up, and then it goes back down. Check this out. The market turned, it formed a high here, but this high was actually lower than the previous higher high. We call it the lower high. And then the market goes back down. It breaks this lower low. It breaks the structure, which is BOS, the break of structure. Breaks the lower low. After breaking the lower low, market forms another low point which is lower than this one, which is called the lower low. I'm trying to be a little bit slower and trying to be more elaborative because I don't want you to be missing out on some important information here, okay? So, now, are you seeing what I'm seeing? I've noticed that the market has given me the first low, a lower high, a lower low, and then another lower high. Oh, okay. The market goes down, breaks again this lower low. Oh, this is interesting. I'm starting to notice now that indeed, that signal that the market gave to me that is changing a trend, the change of character, it was actually the truth. It really did indeed change the trend. And I see that by the series of lower lows, lower highs, lower lows, lower high. And then I'm starting to look for what? My selling point so that I can ride the trend. Remember, trend is our friend. Okay? There are so many things that I'm saying right now that you are going to understand as time goes because, like I said, this information is intertwined, is linked rather. So, by not clearly understanding something in a certain part that I'm explaining, it does not mean you are not going to understand it. It really doesn't mean you will never understand it. Just keep on paying attention. The market goes down, forms a lower low, lower high, another lower low. But notice this here. Instead of the market forming a lower high, maybe somewhere here, just like it did here, just like it did here, without breaking the previous lower high, the market this time around breaks this previous lower high. And just by that, you can tell the market is telling me something. Start looking deep now. As the market closes above the lower high, you realize that it's signaling to you that there's a change in character. Think about it as a behavioral action of your friend, the trend, of course, and you're starting to notice some changes in your friend. He's switching up on you. Sometimes you try to converse with him or her with some huge levels of excitement, but you know, they just get to disappoint you. Their tone is low. Of course, maybe they are sad or something, but I'm just trying to say to you, when your friend is switching up on you, when they're changing their character or rather their behavior towards you, you're going to notice that. Why? Because it's an emotional language that you've learned throughout your period of evolving. Okay, so here the market is giving us a change of character. What does that tell us? We were in a downtrend, and the market is saying to us, I am changing. I'm no longer going down. That's what it means. It simply means I'm no longer interested in going down. Or rather, there are so many factors now that are affecting me not to have the momentum to go down anymore. So here's what I'm doing. I'm switching. I'm changing the character. I'm starting to go up. And this here, the break of the lower high, is the first signal that the market is intending, or rather has a possibility of going up. Remember, the graph is a representation of statistical information about what the buyers and the sellers are doing in the market. The buyers and the sellers are regarded as a battle between the bears and the bulls. The bulls representing the buyers and the sellers represented by the bears. Okay? So, when the market is telling you that it's switching, it's changing the character, it simply means it's no longer having the momentum to continue with the previous trend. It's starting a new trend. And then, as we can see here, just after the market has given us a charge, it goes down. That is what we call a pullback, or rather a discount in the market. And then it forms a point that is higher. It's a lower point that is higher than the previous lower point, which is a higher low. And then it goes back up. It breaks the higher point, that is a break of structure, to form a higher high. Now, when you get a little bit more advanced, as we are going to be teaching you some advanced knowledge, of course, throughout this course, you will find a way, just after the change of character, you will find a way to validate, or rather confirm, this first pullback after the change of character. So, meaning, when you begin to become an advanced trader, you will take an entry as early as just after the market has switched trends. And that is the advantage, because that is exactly what we want to equip you into. We want to give you the best tools that will enhance you to have a better edge over other traders in the market. The market goes up, forms a higher high, that is higher than previous high, comes back, forms a higher low, goes back up, breaks the structure, and then now, this time around, remember, the market comes down, and instead of breaking this higher low, if it turns without breaking this higher low, what do we call that? You guessed it well. We call it a higher low. And then it goes up. But this time around, I want you to notice something. The market did not manage to break this previous high. Instead, it formed a lower high and then came back at the same almost horizontal level as the previous higher low, went back up from the higher high, which is higher than the previous lower high, and then came back down from the higher low. And then, you can notice that now there's no series of lower lows, or rather higher highs following each other consecutively, indicating to us that the market is in a downtrend, or rather in a downtrend, meaning this is just a confusing moment. What do you do in a confusing moment? You simply just relax. You fold your arms and then you wait. As the market goes up like that, you check which direction will the market give you a momentum that will form a BOS, meaning the market breaking a structure. Now, here we notice that the market is breaking the structure to the higher side, to the upper side, breaking this higher high here, breaking this higher high here, breaking this higher high here, the market closes above. Then there's a pullback. This breaking of the higher high here, you can tell it's almost like this breaking of the lower high here. It's also regarded as a change of character. But because I don't want to confuse you, let's just call it a break of structure and then continue. The market goes up, comes back down. When the market comes back down, it's giving you a discount, meaning it's giving you an entry at a cheaper price, because the aim is to always buy low and sell high. That is something that you will learn as time goes. I hope this whole explanation here makes clear sense. I noticed I took some time here because this is exactly what you will be needing throughout the course. In so many of other trading courses out there, this part is a part that actually makes their advanced course. But here we brought it into the basic fundamental course because we noticed that it's very, very fundamental for you to understand how to spot out a trend change, how to know when the market is switching up trends. Okay, let's dive deep into another topic: support and resistance. Let's focus here. We have this house here. This house have a window, a door, a window, a roof. But our main focus is going to be on the floor and also on the roof. Now, I want you to pay careful attention because this here is a very fundamental building block of what is going to help you to understand deep, deep levels of what you call the support and resistance. Now, the house having a floor here, it has also the roof. So I want you to imagine, let's say you have a tennis ball in your hand, a bouncing tennis ball, the rubber kind of, yes. So when you're having the tennis ball in your hand, you take the tennis ball and you throw it with some maximum pressure to the downside. What's going to happen to that tennis ball when it hits the floor? It will bounce, right? Yes. So now, when the tennis ball bounces, depending on the strength of the roof, it's also expected that when it bounces and hits the roof, or rather the ceiling, it's expected to come back down, right? So here, this point, the support is our floor, okay? And the roof here is our resistance. The support is supporting the tennis ball to have a surface at a lower level which it can bounce on to go on to the upper side. And then at the upper side, the resistance, the roof is resisting the tennis ball from penetrating, which is the ceiling. It's resisting the tennis ball from penetrating into the ceiling. Okay. So just as it's resisting the tennis ball from penetrating, the tennis ball comes back down again. I hope you understand it. Now, with that explanation that I explained there at the house, I want us to focus here now. And this is actually me trying to help you understand consolidation in a better way, because now I know you really do understand a trend and you know how to spot out a trend when it's changing. Now, let's say the market is here. Let's say the market is here. The market goes up. And as it goes up, it comes back down. Now we have here our first point, which is a high. It comes back down and then it turns again. Let's say now the market is here in the middle, right? Sorry about that. We have a point that is high, we have a point that is low, and then the market goes back almost, or rather exactly, at the same level as the previous high. It forms another high. Oh, wow, that's interesting. Okay. Because it's not giving us any change of character or any break of structure. Now, what does that tell us? It tells us that there's something that is resisting the market. That is our roof. There's something that is resisting the market from penetrating to the upside. The market drops. As the market is somewhere in the middle around here, you will take a line which is called a trend line. Is a tool that will be provided to you in the platform that you will be using for trading, which I will teach you how to use it later on. I'm sorry about that. You take your trend line, put it at the first point, draw it pass through the second point. You don't just join it from here to here. Rather, what you do is you draw it from here, from this point, and then you let it pass through and go into the future. I'll explain to you the reason for that. As the market goes down, you notice I have a first point, I have a second point, and then the market drops. That is good enough to signal to us that the market has found a resistance at the upper level. So, what is expected is that when the market goes back to that resistant level, just like here, the market is expected to do what? To bounce. Okay? So now that we have spotted out our resistance, the market goes down, down, forms another low here, which is the second low. It goes back up. So when the market is somewhere in the middle of somewhere around here, we can already identify that we have two lows at the bottom. We are going to do the same thing. We take the trend line, we draw it, pass through the second low, and then it surpasses, it goes into the future. Now, check this out. The market goes up, it comes here. Here, when the market is touching the trend line, which is in this case representing the resistance, the roof rather, we are expecting the tennis ball. We are expecting the market, our tennis ball here, to do what? To bounce and go down. Will that always be the case? No, that will not always be the case, but I will help you to understand it at a later stage. And then as the market hits here, what we do is that we check, okay, there was a first touch on the resistance, there's a second touch on the resistance, and then on the third touch, the market is expected to drop. And from a point where we are expecting the market to drop, that is our entry point to sell. That is our entry point to participate in the market and state our prediction that the market is going to drop. And as the market drops, we are in the profit. We are profiting. And then when the market comes here, this point is also a third point for the flow, which means we expect our tennis ball, the market, of course, to bounce on the floor and go up, right? What do we do here? We are expecting to buy. But instead of just buying here, remember you still have an open position of sell. You are still in the profit and the market is about to return back. So in other words, let's say you were into, as the market was dropping, you were gaining $1, $2, $3, $4, maybe $5, and the market is here, you are profiting $5. Should the market return to the same level where you took your entry, you are gonna be back to zero. So to avoid that, when the market signals to you that it's about to rise, you take your profit. In other words, you close your entry with a profit and then you take another entry, you buy. As the market goes up, 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 it reaches this high level, I want you to be aware of something. You can sell again here, but whenever there's an opportunity presented for you to sell and an opportunity for you to buy, you don't just buy just because the market is on the floor, or you don't just buy just because the market is on the you don't just sell because the market is on the roof. No, there are confirmations that we will be using, and those confirmations you will learn them a bit later. I just want you to focus at a stage where we are. Remember what I said. This is a link. It's a chain connecting to one another. The market comes up here. You bought here. And then as the market reaches there, it signals to you we are now at the resistance. What do we do at the resistance? We expect to sell, right? So instead of selling while you still have an open position, you close your position with a take profit, with some profit, and then that's it. So I hope now you understand what you can do when the market is in a consolidating phase. Okay? Now, to explain the consolidation even further, let's look deep into this house. This is very interesting. Let's say we are here. We have the first floor, the second floor, and the third floor. Okay, as you can see here. So let's say now you throw your tennis ball downwards, it bounces, and you have thrown it with some serious momentum that when it goes back up, it actually somehow miraculously breaks the ceiling, right? Maybe the ceiling, or rather the roof, is weak. Okay, instead of confusing ourselves here, let me help you to understand it better. Let's say you have a gun and the roof is made of wood. And then the gun is so powerful that the bullet can actually penetrate the roof. Okay? So you shoot up and then the bullet penetrates the roof. But in the middle, somewhere here, the bullet loses its momentum and then turns back, falls. Remember, you're not just going to shoot it straight up. The market does not move like that. It moves slightly to the upside, slightly to the downside, overall to the right hand side. Okay? So let's say this bullet was here. It goes up, and then that's it, breaks the roof. And then just after breaking the roof, somewhere here, it turns and then it goes back down. It falls where? On the floor. Okay? So after it breaks the roof, it's in this level now. This higher point, which was actually a roof for those who are in this level, in this floor, it's no longer a higher point for those who are in this floor. It's actually the floor. It's actually a lower point, which is the support. Okay? So now, as the market is here, on the floor here, it means the roof has changed into becoming the floor. For those who are below the roof, they see it as the roof, but those who are above the roof, it's actually the floor for them. So that is exactly what I'm trying to help you understand here. Because resistance can change into support and support can change into resistance. For example, let's say our friend up in this floor has a gun also. He shoots down, the bullet penetrates the wooden floor and then comes around here. If the bullet can somehow miraculously turn back up, this will no longer be the floor which it broke at around this point, but it has now changed its interface into the resistance, which is the roof. Okay, I hope you get to understand it even better when we dive deep into this illustration here. Suppose the market is here. It goes up, gives us a high, comes back down, gives us a low, goes back up to the same level as the previous high, gives us the second high. It's not a higher high. It's not actually a clear higher high or a higher point or a higher low, but the market goes down. So we already have 2 points where the market was turning at the top. Okay, so those 2 points are what we are going to use as our points to demonstrate where the market found a resistance. How are we going to do that in order for us to be able to notice it in the future. We are going to take the line which I said it's a trend line, which is a tool you will find in the platform of which you will be using, or I will be helping you throughout to understand it even better throughout this course. And then you take that trend line, draw it surpassing this second high, and as it surpasses this second high, I need you to notice that it becomes it overlaps, goes into the future. The market is around here. It goes back, it comes down, forms the second low. Let's say the market is now playing around the middle here between the roof and the floor. This here demonstrate, let's just say our second floor here. What has the potential to happen in the market on this second floor is that the market may somehow, let's say this is a bullet instead of a tennis, right? Let's say it's a bullet and this resistance here is a wooden resistance. It's a wooden roof. And then this floor here is a wooden floor. That bullet has the potential to penetrate depending on the strength and the power, of the gun. So suppose the bullet penetrates here and goes up. Now this here is something that we call a transmutation, the resistance turning into the support. Why is that? Because as now the bullet is above, which is the market, of course, it represents what? It represents the floor. Because if the market is above, the level at which is above, if it was the resistance, then it becomes a floor. Okay? And then on the floor here, what we expect to do on the floor, just like I explained in the previous lesson, we expect to buy on the floor and then we expect to sell on the resistance. So now that we have spotted this out, that the market has actually broken the resistance, which we have drawn by the help of these two high points, then we're starting to look at it as our floor. And then at the floor, we expect to buy. Of course, you don't just buy because the market is on the floor. We will wait for some confirmations, which are things we haven't spoken deeply about at this point. You will learn a bit later. Okay? So you buy here, the market goes up, and you are in the money. And I want you to notice something here, guys. When the market actually breaks this resistance, breaking this high point, in other words, it gives you what? A change of character. It signals to you that I am no longer in consolidation. Rather, there's a potential that the buyers may start taking over. Okay? That is a change of character. That is a break of structure to the upside. So, like I said, whatever position they break into, the directional movement they break into, if they break the structure to the upside, we start looking for more buys. When they break the structure to the downside, we start looking for more sells, which means the bears, or rather the sellers, are beginning to have momentum in the market. I hope it makes clear sense. Let me explain here right now for the sell side. We have here our first point, which is the low, our second point, which is also a low, then the market goes up. And as the market goes up, we draw our floor, our support, okay? We draw our support using our trend line. It passes and it goes into the future. And then, suppose the market does not break this resistance, but instead it bounces and then we sell. We sell here. And then when it gets to the floor, as expected, we expect the market to do what? To actually bounce on the floor, right? But suppose this bullet was powerful and then it breaks this floor, our support. What we begin to notice is the transmutation, the change in interface. The broken support becomes resistance. Okay? Now, Because the market is below, we know what is above is the resistance. So because the market is now below, and remember, the market broke this point while we are still in the money. Maybe when the market was here at this support level, it gave you actually a signal that I'm still going to continue. Because like I said, you don't just buy because the market is on the floor. There might be a signal that appears to tell you that the market still stand a chance to continue into that direction. So suppose the market has given us a signal that we should hold our position without taking profit, as it signals that it's breaking the lower point, forming a change of character, diving into a downtrend, and we start looking for our sell. Where will we target our sell? Here now at the resistance. Why we call it as a resistance? Because it has turned from support to resistance as the market broke it here. And then we sell. Now, as we sell here, the market goes down. When the market actually goes down, it means now we are in profit of two entries, because the market here gave us a confirmation that it's still going to continue. And then here we had taken a sell entry. And then here we have taken another sell entry. That is what we call scaling in. Scaling in simply means adding into a position. I hope you understand what I'm trying to help you understand here. Now, let us look deep into it. The analogy of support and resistance, but somehow in a trend, because I have spoken about support and resistance, but in a consolidating phase, right? So now I want to explain further to you how to draw support and resistance on the market that is trending. So let's say here the market was going up, gives us a high, comes back down, gives us a low, goes back up, comes back low. As the market is here, you can already notice we have 2 points at the top side, which is this first point, the high, and the higher high. And remember, it takes 2 points or more to help us to be able to draw our resistance, or rather our support. Now, because this is the points at the higher side, it means this is gonna be our resistance. It's our resistance because it's on the higher side. And then as the market drops, forms the second point, which is now a higher low, we are able now to draw a trend line that shows that the market is actually going up. You see? So now, check this out. We have here a low, we have a higher low, and then this second point, we use these 2 points to draw our support level. So in other words, because we had stated earlier that in an uptrend, we focus mainly on buy. And here we can see it's an uptrend. And how were we able to see that? By the series of high and higher high, low and higher low. Now we know we are in an uptrend. And just by the look of this trend line, you can see by the slope of the trend that we are actually facing to the upside. So, like we said, on the third point, that's where we are expecting to buy. Now the market comes here and then we buy. Where do we put our stop loss? Below the previous low, which is this low, high low here. We put our stop loss there. And then where will we target our take profit? Where will we actually take our money home with us? We have two options, just like I explained in the previous lesson. You can take profit when the market reaches the roof, because you have taken the trade in the direction towards the roof. Or rather, you can wait for a change of character. Okay, so suppose we buy here. As the market goes up, breaks this structure, we are in the money. Market reaches the resistance. Some people may take their profits here, and then some people may still hold their position because the market has not given them any change of character. Okay, and as the market comes back to this support here, what other people will do will scale in. In other words, they will put another entry here because their first entry is still in profit. They are going to take another second entry here so that they may ride the trend more and more. And then the market goes up. And as you can spot out here, the market failed to reach that higher point, the resistance, but it was able to break the previous higher high. Okay. So as the market comes back down, it does what? It breaks the floor. Wait a minute. We know there's something that happens when the market breaks the previous trend, right? When the market breaks our trend line, what happens is that trend line changes its interface. In other words, we no longer see the trend line as the same way we did before. If the trend line was symbolizing a support for us and it gets broken, then now it starts to resemble a resistance. Why? Because the market is now below it. And when the market goes up to that point, it's now what? The support has turned into the resistance. What do we expect to do in a resistance? We expect to sell, right? Yes. So right here, when the market is changing its interface, breaking this trend line, it's actually also signaling to the buyers that it's about time they take their profits. So in other words, a break of a trend line also symbolizes a change of character. Why? Because the market was in an uptrend. It was ranging. It was, let me say, the market was moving in between this this phase here, these trend lines, right? But then eventually it broke the trend line and it started signaling that it's going down. Check this out. Just after breaking this trend line here, our support, of course, this low point is actually lower than this point. If you can look at it well, this low point is lower than this lower point. That gives us a what? It gives us a change of character. And as the market has now told us that it has changed the character, it was an uptrend, right? What should we start expecting? We are expecting a trend that is opposite to the uptrend to form, and that is a downtrend, right? Now, from here, let's say as the market drops, it continues, it drops here. We have dived deep into now the downtrend, right? So the market comes, gives us a 10 here, goes up, gives us a 10 here, comes down, breaks this previous low, which is the B, it's giving us actually a BOS, breaks us the previous low, comes back down, and somewhere here, when you are still here, when the market is still here, suppose you haven't seen this, the right hand part from here, okay? This whole part, you haven't seen it yet. And then you already have a low and a lower low. What you can actually do is to join those 2 points with a trend line going into the future, meaning surpassing this level here. Okay, and then that trend line will become handy for us as time goes, and then the market goes back up, gives us a second high, which is now a lower high because it's lower than the previous high. And then as the market goes down, we already have 2 points at the higher side, which allows us to draw a resistance. Okay, so after drawing this resistance, we are expecting two things to happen. The market is either gonna come this side, bounce on the floor before it goes back to the resistance, the roof, or rather, it may turn somewhere before it even hits our lower trend line. And should any of those conditions happen, our target is to see the market, our aim, or rather, what we are waiting for is to see the market coming back to hit the roof, which in this case is the resistance. Why? Because you and I know in a downtrend, we want to ride the trend. We don't want to betray our friend. Therefore, therefore, we are aiming to take our sell entry at the resistance. Okay? And then this is exactly what we do. Just this point here, we sell. And then the market drops. When it comes back to the floor, that's where we take our profit. Or rather, you can wait for the market to give you an actual change of character, of which you are going to spot it out by the market breaking a trend line, or rather giving you an actual change of character. So what happens is the market comes back up, and then those sellers who have sold here at this point may still scale in and add more positions, enter the market and still take sell entries, and then they sell. But notice here, the market turns without actually coming back to touch this. Suppose this trend line was surpassing, coming somewhere around here, right? Now, let's say the market turns and it forms a lower low. How will we know it's about time to take profit? We will wait for the market to break out and close above this upper trend line, to close above the roof. What will that be signaling to us? It will be signaling to us that the roof will now become the floor. Okay? So as the market closes above, we now know that it's about time we take our profits home. And as the market breaks this upper trend line, what we do is to wait for the market to return and retest. What the term retest actually means is that we will see if the market has momentum or the strength to break this floor, or whether it will continue with the movement which it has already initiated by signaling to us that is forming a new trend. Is that clear? If you have any question based on any based on any explanation that I've given in the past lessons or this one, feel free to ask questions in the comment section, or you can send us a message on our WhatsApp, uh, and you can contact us in the platforms that we will be making available for you to contact us on. And that was the end of part A of unit 1. Thank you so much for focusing until you reach this point. If there's anything you did not understand that I explained, you can watch this video again and again. What you can also do is to ask questions and make sure you understand it to the fullest, because of course, this is for the benefit of your trading journey. Thank you very much.